How many stocks do you have in your portfolio? Can you tell me exactly what each company does that is in your portfolio? How many sectors do you have in your portfolio? Also, how much money have you allocated to every single stock that is in your portfolio? If you don't have answers to these questions, or if you don't have convincing answer to these questions, this video is for you. This is part 3 of my stock market series. In part 1, we discussed about what is NSE, BSE, Nifty, Sensex, what is all this and how can you make a lot of money using all this information. In chapter 2 of this series, we discussed about how a private company becomes public, what is an IPO process, what is FPO process, and the million-dollar question, should you subscribe to an IPO or not? If you have not watched those 2 videos, please watch them first and then come back to this video. In this video, we will talk about how to make an amazing portfolio that not only beats the market when it's a bull run, but also preserves your wealth when there is a crash. And that is even more important. See, it is extremely important to have a system when you invest in a stock market. If you are always driven by emotions, you will not make money. You should have a very strict process that you should always follow, and if you follow that, I promise you, you will be successful. Because if you don't have a process, sometimes you will invest a lot of money and that stock would just crash, and sometimes you will put too less when the stock would rally. So we need to have a system that will help us build wealth over a longer term. Now, this made me build a 6-step framework, and I promise you, if you follow this 6-step framework, you will definitely be successful in your long run. So let's start. Rule number 1, the 5% rule. You basically should never invest more than 5% of your money in any single company. That basically means your portfolio must have at least 15 to 20 stocks. Now a lot of people keep asking me to tell them 2-3 good companies where they can invest. And I always wonder what is the answer to this question. You can't build a portfolio with just 2-3 good companies. See, any company, literally any company can collapse. Or at least you should be ready for that. And that is the reason your wealth should be distributed. You should never invest more than 5% in any single company. Let's take an example. Suppose you want to invest 20 lakh rupees in the stock market. Now you will split this into 20 equal parts, basically 5% each. Now that basically means you will not invest more than 1 lakh rupees in any single stock. So now your portfolio will have 20 stocks, and in every single stock you will invest 1 lakh rupees. This saves your portfolio from this immense crash that can happen to any company at any given point of time. See, a lot of people are thrown out of the stock market because they are driven by emotions. They think some company is really amazing and they put a lot of money in that stock. For example, suppose you have a 20 lakh portfolio. Out of these 20 lakh, you put 15 lakh in some random X stock. In that case, if that stock collapses, your entire portfolio gets collapsed, and then you would lose all your money and you would be thrown out of the market. An extremely good example here is Gitanjali Gems. If you have not heard about this company, just Google it. This is about Nirav Modi's scam.
And there's breaking news coming in. India's investigative agency CBI has registered an FIR against Gitanjali Group of companies owned by Mehul Choksi, based on complaint by Punjab National Bank dated 13th February 2018.
Look at this chart. This is the chart of Gitanjali Gems. If you look at November 2017, you would see the stock was trading at almost 100 rupees. And within 1.5 years, this stock crashed to just 1 rupee. If you had invested a lot of money in this company, you would have literally lost all your money. And now this was not even a bad company. During November 2017, this was a decent company to invest. And people won't know about the scam until it is too late. And hence, please stick to this rule. You should have an extremely strong reason to break this rule. Ideally, I would not suggest you to break this rule. Always follow this rule. Have 20 stocks in your portfolio and allocate 5% of your wealth in every single stock. Rule number 2, build your positions slowly. Now, in the first example, we talked about a 20 lakh portfolio where I would invest 1 lakh rupee in every single stock, which is just basically 5%. Your portfolio could be 1 lakh rupee, 10 lakh rupee, 20 lakh rupee, 1 crore. It doesn't really matter. What matters is allocate 5% in any single stock. Now, in the previous example, we talked about allocating 1 lakh rupee in every single stock. Now, in this case, I would not invest the complete 1 lakh in just one go. I would break this into at least 4 equal parts, which basically means if I have to invest 1 lakh rupee in some stock, I would break that into 4 parts, which is 25,000 each, and then I would do my first investment of 25,000 in that stock and then keep analyzing the stock for a few weeks, which basically means, let's say you want to buy some stock today, you invest this 1/4 of this 1 lakh that you have. Now you invested 25,000 in it. Now you will analyze the stock for a few weeks. If it crashes, if it goes up, and whatever is happening with the stock. And then you would do your second investment of again 25,000. Then the third investment, and then the fourth investment. After the fourth investment, when you have maxed out, when you have invested all the complete 1 lakh rupee, you will not invest more, no matter what. You would not downward average, you would not upward average. Now, the reason I am telling you to build your position slowly is to understand downward averaging. If your stock crashes after you put your first investment, you have the ability to downward average because you still have to invest 75,000 more. If you follow this rule, you would maximize your returns in every single stock. Here, I'll again take an example of my favorite stock, to be honest, which is Medanta. Now look at this chart of Medanta. This was IPO'd in 2022 and it was almost like 350-400 rupees. Today it is trading at almost 1200-1300 rupees. Now if I want to build positions in Medanta, I would not put the entire 1 lakh in just one go. I'll put my 25,000 here and then I'll just wait. If it crashes by let's say 3, 4, 5%, I'll do my second investment. I'll wait for a quarter, I'll see the results and then I'll put another 25,000 based on the results. And when I'm done with 1 lakh, I will not invest more. I should have extremely strong reason to invest more money in this company. Stick to this rule and I promise you, you will never be thrown out of the market. Any stock would crash, any stock would rally, you will maximize your returns. Because your positions were built slowly after analyzing the company over a period, which basically means you will always make a good decision. This was rule number 2. Now let's move on to rule number 3. The third step of this framework is sector diversification. Now a few years ago, I reviewed someone's portfolio who has around 20 stocks in his portfolio, but the stocks were Axis Bank, HDFC Bank, ICICI Bank, Bandhan, SBI, PNB. Do you think it's a good portfolio? If out of 20 stocks, let's say you have 15 banking stocks, do you really think it's a good portfolio? See, it's good and bad both. It's extremely volatile. If the banking sector performs well, the portfolio would perform well, but if the banking sector does not perform, this would completely crash. And hence, your portfolio should have at least 4 to 5 sectors at all times. And there's a small homework for you. Look at your portfolio right now and check how many sectors are there in your portfolio. Ideally, you should definitely have 4 to 5 sectors in your portfolio. Now, there's a strong reason behind that. Understand this. If you have the best stock that belongs to some sector and now that sector is not performing because of the market conditions, because of multiple other reasons, your best company would also not perform. In fact, it would bleed and it might make you lose a lot of money. And hence, a well-balanced portfolio must have at least 4 to 5 sectors. And the reason behind that is, if one sector does not perform, the remaining sectors would perform well and help the portfolio grow. So during the times of crash and also during the times of bull run, your portfolio would grow and would not also fall less during the times of crash. And this is the reason you should always have multiple sectors in your portfolio. A small example I can give you here is, first of all, a few sectors that we have in the Indian stock market. Think about financials, IT, healthcare, consumer staples. These are one of a few sectors that we have in the stock market. And now, if you want to invest your money, understand about this. During COVID, the healthcare sector performed really well, like really well. But after that, it almost got saturated. Similarly, last year, the IT sector performed really well. Because again of the AI boom and all those other things, And that is the reason any sector, in fact, any sector would perform good and then would just stabilize. And that is the reason if your portfolio has multiple sectors, it would grow no matter if the sector is not performing or performing, because you have a collection of sectors and one of them would definitely perform and your portfolio would keep on growing. And that is our third rule. This was our rule number 3. So always stick to this rule. Never ever build a portfolio that has almost all the stocks from the same sector. It would give you a heart attack. Now let's move on to rule number 4. Rule number 4, 80-20 rule. Now this is a very popular rule that can be applied almost everywhere, and in your portfolio, definitely. This basically means 80% of your portfolio should be made up of good companies, really good companies. See, there are a lot of options available. You have large caps, mid caps, small caps, then a lot of sectors. How do you make a portfolio? Ideally, 80% of this should be invested in large and mid caps. Ideally, because these are comparatively safe. And even in this large and mid caps, really good businesses that you have analyzed. 80% of your money should be logged into these good companies. The remaining 20%, you can use it for speculation, for a bit of gamble if you really want to do. For example, I would say, let's say a lot of stocks are government backed, and I can name a few to you right now. For example, I gave an example in my last video which is about Heritage Foods, which is very closely linked to N. Chandrababu Naidu, since he is helping BJP right now and they have formed the government together. This basically means there is a probability that Heritage Food might grow a lot, but this is only and only if this government goes on and this collaboration works really well. When the government changes, this stock might collapse. Similarly, Adani stocks, they work really well, and I think you know the reason, I won't just tell you. But basically all these stocks, Adani stocks, Heritage Food, these are the stocks that are working, that are moving because of the government. If something changes there, these stocks might crash, and hence these are not fundamentally good businesses. These are just favored by the current government, and hence only 20% of your wealth should be logged into these kind of stocks, which are extremely risky and they can fall a lot, they can grow a lot. Use it for a bit of adrenaline rush, for speculation, for kind of growth, but do not go beyond 20%. 80% only good, fundamentally good businesses. 20% do whatever or try to do some speculation. This was rule number 4. Now I wanted to cover the remaining rules in this video as well, but I think the video would get a bit too long, so I will cover all of that in part 2 of this video. But before that, in this video I specifically talked about the stock market portfolio. But before this, you should definitely have a really good mutual fund portfolio. Now if you need help in building mutual fund portfolio, please watch this entire playlist. I have covered everything about mutual funds and how to build a great portfolio in these videos. Please watch it first. Also, if you want me to review your portfolio, comment on this video. I look at all the comments, and every week we pick one lucky winner who gets to talk to me, where I can review your portfolio and you can ask me as many questions as you want. Until then, keep investing in your dreams.